For many startups, securing venture capital funding is a defining moment, one that can accelerate growth, provide access to invaluable networks, and shape the company's future. For venture capitalists, it's important to remember, startups aren't just choosing money. They're choosing a partner. Founders are selective. They're evaluating VCs just as much as VCs are evaluating them. They don't just look for any investor, they look for the right partner. A venture capitalist is more than a source of cash. They become an advisor, a strategic ally, and sometimes even a board member. So, what do startups look for when deciding which VC firm to take money from? Startups want investors who understand their industry. Whether it's AI, biotech, fintech, or cleantech, a VC who specializes in their space can bring more than just money. They bring deep market knowledge, customer insights, and connections to key players. A clienti-tech startup, for example, doesn't just want an investor who writes checks. They need someone who understands regulations, technology, and the competitive landscape. That kind of investor can open doors that money alone cannot. For VCs, this means specialization and credibility matter. Generalist capital is increasingly less attractive to founders in specialized sectors. One of the greatest advantages of securing venture capital funding is gaining access to the investor's network. Beyond the capital itself, a strong network can significantly accelerate a startup's growth and success. Startups often seek out venture capital firms that can open doors to potential customers and corporate partners. These connections can help validate the product, drive early revenue, and create strategic opportunities that might otherwise be difficult to access. In addition, venture capital firms play a crucial role in helping startups secure future funding. By introducing founders to later-stage investors, they assist in building the relationships necessary for subsequent rounds of financing. This support can be critical as companies move from early growth to scaling operations. Another important area where a venture capital firm's network proves invaluable is talent acquisition. Experienced executives, technical leaders, and engineers are vital to building a high-performing company. Venture capitalists who can connect startups with exceptional talent can have a profound impact on a company's ability to scale effectively. In many cases, a single well-timed introduction to a key hire, customer, or strategic partner can prove even more valuable than the initial funding itself. The right connections, facilitated by a well-connected venture capital firm, often make the difference between steady growth and breakthrough success. Thus, as a venture capitalist, your network is everything. Beyond the money that you can secure, the network is part of your value proposition. Remember that founders look for VCs that can open doors to customers, capital, and talent, and not just write checks. Not all venture capital firms are created equal. Startups pay close attention to investors' reputation before choosing to partner with them. Founders carefully consider whether a particular venture capital firm has backed successful companies in the past and whether they have a history of supporting entrepreneurs through challenging times. They are equally cautious about avoiding investors who are known for being overly controlling or difficult to work with. Before accepting funding, founders often speak directly with other entrepreneurs who have worked with the venture capital firm. They seek insights into several critical questions. They want to know whether the investor truly adds value beyond providing capital or whether they simply write checks without offering meaningful support. They also look into whether the investor pressures portfolio companies to grow at an unsustainable pace, potentially putting the long-term health of the business at risk. In addition, founders investigate whether the venture capital firm is genuinely founder-friendly, or if it has a reputation for stepping in and replacing CEOs when challenges arise. A great venture capital firm builds a strong and lasting reputation by consistently helping its portfolio companies grow and succeed, not merely by funding them. Supportive partnerships, grounded in trust and shared vision, are often what distinguish the most respected investors in the startup community. Keep in mind that startups want investors who are founder-friendly, but also bring discipline and value. Your reputation in the founder community precedes you and directly impacts the quality of deals you get access to. Some VCs are hands-on, actively guiding their startups through hiring, strategy, fundraising, and scaling. Others are more hands-off, preferring to check in only at board meetings. Startups look for an investor whose level of involvement matches their needs. Some founders want frequent mentorship, while others prefer independence with minimal interference. The best VCs adapt to what the startup needs rather than imposing a one-size-fits-all approach. A startup's journey doesn't end after one funding round. Founders need investors who can support them across multiple stages of growth. This means having deep enough pockets to invest in follow-on rounds, aligning on a shared vision for the company's growth and exit strategy, and understanding the right balance between aggressive scaling and sustainable business building. If you're misaligned on pace, vision, or funding philosophy, it becomes a long-term liability. Startups want VCs who won't just push for quick returns at the expense of durability. At the end of the day, venture capital is a people business. A funding relationship can last 5 to 10 years, so founders want to work with investors they genuinely trust and respect. Good founders don't just take money from the highest bidder. They look for VCs they can have honest, difficult conversations with, especially during hard times. A great investor-founder relationship is built on 3 main characteristics. Trust. Can the founder be transparent about challenges? Beyond trust, then there is mutual respect. Does the VC believe in the founder's vision and leadership? And finally, clear communication. Can they have open, constructive discussions about strategy? For VCs, strong relationships aren't just nice to have, they're strategic assets. Trust drives transparency, and transparency helps you intervene early when things go off track. Raising venture capital isn't just about securing funding, it's about choosing the right partner for the journey ahead. The best founders don't chase the highest valuation, they chase the most aligned, helpful, and trusted investors. If you want to back the best companies, start by being the kind of investor the best founders are looking for. Bring expertise, be present, build trust, offer real help, not just a term sheet. When you do, you don't just fund startups, you help build enduring companies.